Hello, everyone, and good morning or good afternoon, depending on where you are. Welcome to Athabasca University's Effective Business Second Learning Webinar Series. Today, we are going to talk about financial planning. And this learning webinar series is where we bring key topics to discuss on business issues. So this is the second in the series, and we have today we're going to talk about financial planning. As most of you know, myself included, financial planning is crucial in our lives, and we don't sometimes know or have a solid understanding of what it is. So today we are fortunate to have our AU MBA's alum, Scott Dunn, MBA 04, to walk us through some of the key aspects in financial planning. So a little bit about Scott Dunn. Scott is an MBA alum of 2004. He has over 15 years career experience in financial and banking. And Scott is also a longtime volunteer for the Junior Achievement Program in Edmonton for over 14 years. So Scott is a well-rounded person, you would say. Scott, do you want to say a quick hello, and maybe also you could share your MBA experience at AU with the listeners today?
Yeah, absolutely. Thanks so much. And first off, thanks so much for inviting me into this today. I really appreciate the opportunity, and good morning, good afternoon to everybody, again, depending where you're at. My experience with the MBA program, I think like most people, investigated a number of different alternatives in terms of pursuing graduate studies, and there was actually a pretty long list of reasons why I personally chose Athabasca. I think in part was because of the experience level and the background of the other students in the program specifically. No disrespect to anybody who's come straight from an undergraduate program to a graduate program, but I really didn't feel like I could gain the kinds of insights that I was really looking for with those other programs where that seems to be the majority of the students. So once I got into the program, I think that really rang true for me. I learned so much from the other people that I was working alongside of, and even though for the most part, you're not working alongside of your cohorts face to face. A lot of good conversations. Oftentimes you pick up the phone and talk to each other, and where there were opportunities to have the on-site residential electives, those are absolutely phenomenal. Met some people that I'm still in touch with, to this day. As an aside, when I started the program, my two daughters were aged 8 and 11, and the prospect of sort of going to night or weekend school at a traditional bricks and mortar school wasn't that appealing, right? Lots going on in our family at that point, so it really enabled me to balance some things, and looking back on it, one of the best decisions I ever made.
Great, thank you for that, Scott. So before we begin, just a couple of house rules. This is a listen-only webinar, so you won't be able to speak or ask questions during the webinar. However, you can type in your questions in the questions box you see on the screen. So if you can see on the screen, there's a little arrow that says questions. So please type in your questions in that box. As a matter of fact, I just want to make sure that before we begin, that you can hear me okay, and you can see the screen. Yeah, that was something that I kind of missed asking before we started. Okay, good. Thank you, Jason. Sometimes you never know with technology. You'll be talking all this while, and you're out in the void. Okay, thanks, James. Great. So with that, I will pass the presentation to Scott. And if you have any questions, like I said, feel free to start asking them in the question box, and we'll get to your questions in a timely manner. At the end of this presentation, there is a question and answer period. So with that, I'm going to give the presentation to Scott, and Scott should be able to do the presentation now.
Okay. Make sure that can go forward here.
There we go.
Oh, there we go. Perfect. Awesome. Okay, so four key pieces that really felt would be relevant to this type of a discussion, this type of a webinar. So I won't reread what you could already see on the screen. You've already read it. So I'm going to step right into tax-free savings accounts. And this one, for me, at least in my experience, as a financial planner, as a wealth professional, seems to be one of the most misunderstood programs that's available within Canada, right? I think most people have a pretty good understanding of RRSPs, why those are important, what the benefits are. But when it comes to the tax-free savings account program, again, a lot of maybe misconceptions, misunderstandings, and people maybe don't appreciate how much impact this type of an account can actually have on your overall financial future and your financial health. So I thought it was a really, really good place to start. There's a quote there from back in 2008, and I would actually agree with that. I think it's unless you own a business and you've got some things that you can do on the tax side there, if you're like most of us and you're an employee of a company, there's not a lot you can do in terms of tax sheltering, and the tax-free savings account, as the name implies, gives you the ability to do some things that, in some respects, mirror RSPs, but at the same time, too, have some pretty distinct differences and advantages that take an opportunity to step through here today. So again, you can see those are the eligibility pieces. There's 4 there, so pretty wide range of eligibility on the tax-free account. And really, again, in my experience as a wealth professional, a tax-free account can suit a number of different needs. And, you see there's sort of 3 stages that we've got laid out there: saving years, the investment years, and the retirement years. And the tax-free can be used for different purposes, at each stage of life, effectively. To give a couple of examples, right? Whenever a client tells me that they're saving money for purchase of a vehicle at some point in the future, I always have a discussion with them about potentially, using the tax-free savings account as the way to create that savings. And again, it may or may not be the right approach, but I'd say more often than not, it's a very good choice. The other key to this type of a program, in my view at least anyway, is to take advantage of the fact that, again, you can use this for multiple purposes. So, it might be a case where you're saving for a vehicle, but you also want some of your money in the tax-free to, be saving for a different goal. Well, you can invest more than one way within the same tax-free savings account. And again, one of the things I think that a lot of people that I come across maybe misunderstand about the program is they think, well, I'm going to park some money in a tax-free. Well, when you look at how they're invested, oftentimes what I see is they're invested in cash. Well, at today's interest rates, you're not even beating inflation there, right? So you've got a wide range of options in terms of how you can invest in a tax-free. So in any event, that's, again, I think a nice snapshot of how that program can fit in. The one, I'm sorry, I moved slides already, but the very last point on the previous slide was no upper age limit. That really is a key planning benefit for folks that are well into retirement, and things like if they've had RSPs in the past, of course, you convert it to a RIF at that point. That has a minimum withdrawal amount that they have to take out every year, whereas the tax-free does not. So again, you can read faster than I can talk. So again, I'm sure most of you read the bullet points that are on this slide. The ones I really point out, some key differences here between certainly this program and RSP is contributions not tax deductible. So the contributions you're making into a tax-free savings account are, that's dollars that you've already paid the tax on. So having said that, of course, when you make a withdrawal, there are no tax consequences because again, you've already paid the tax on that money. One other key point that I'd really highlight here is over contributions. You have to be really, really careful that you don't over contribute. And I see many times where people have set up a tax-free, they made their contributions, at some point you make a withdrawal, and then you can make a recontribution, if you will, of that money that you've withdrawn, but there's some specific timings that you have to follow, and I find a lot of people get caught up in that. And one of the best pieces of advice that I have for people is, if you haven't done it already, set up an account with Canada Revenue Agency. It's actually really easy to do. You can go on their website, and it's called My Account. One of the benefits of having that set up, and it's very secure, they will send you a key code through the mail after you've registered. Until that time, you only have limited access, but nonetheless, once you have full access, one of the things you can do there is you can go on and you can figure out what your past contribution room that you're carrying for tax-free savings accounts is and how much you've contributed over the years. It's all tracked there. So a really nice feature that I find in some cases people just they don't know about it, and it tends to be one of the first things that I give clients some advice around, just in terms of financial housekeeping. I think that's again one of those things you want to try to stay as organized as possible, but the more investment accounts you have and the more things you've got going on financially, the more challenging that gets, right? Again, a little bit more on tax-free savings accounts. I think I've talked about this already. The second last bullet point there, withdrawal amounts that can be made as a recontribution, if you will. You have to wait until after the end of the calendar year. So let's say you took out money today out of your tax-free. You have to wait until January 1st of 2018 to make that contribution back into your tax-free. If you make it back into that tax-free account sooner, you end up paying a penalty, which unfortunately is 1% a month. So pretty significant. And again, that last bullet point there, again, it won't have any impact on any income-tested benefit programs, which again is a really, really nice feature of the tax-free. So a bit of a recap here in terms of contribution room. So again, if you have a Canada Revenue Agency or a CRA account, again, one of the nice features of that is you're going to be able to track those pieces right on that account. And then here's an example of what it might look like. So this one's a little bit dated. Should probably update this one now, but nonetheless, give you a sense, at least anyway, as to how it works. And again, one of the nice features, I sound like I should probably be working for CRA here, but again, that account that you can set up will track all of that information for you as well. So there's, it removes the need for you to manually track this. I guess a couple of tips here. One of the things I definitely recommend to people is if you have multiple tax-free savings accounts across multiple banks or multiple firms, I think you really want to consider consolidating that into one account, just for ease of record keeping. Now, because you're consolidating in one account, doesn't mean you have to have all of your money in your tax-free invested the same way. I mean, you can have multiple pools of money within that account, just like an RSP, right? You could hold multiple different mutual funds or different stocks and so forth. And, in some cases, that could be for different goals, right? I mentioned earlier, purchase of vehicles is a pretty common thing. Somebody might set aside, say, $20,000 in their tax-free, and the rest of it, maybe another $30,000 set aside for retirement. Well, we'll invest those two pools of money differently, but we keep them in the same account. So, again, just for record-keeping purposes, might be worth considering if you have multiple. I actually saw somebody here a couple of months ago had, I think, 8 different tax-free savings accounts at 8 different firms. And I said, well, how do you keep track, right? And again, if you want to spend your time, effort, and energy there, I guess, but at the same time, I think most people probably have better things to do, right? Life is busy, so one of the benefits, I think, of trying to put it all together. This is a really quick comparison of RSPs and tax-free savings accounts. So I get asked this a lot, what are the differences here, right? So, the differences clearly are contribution limits. There are some similarities there as well, and in terms of contribution limits, unused contribution room can be carried forward from previous years. So, one of the things you might be wondering is, well, if I haven't taken advantage of the tax-free savings account program, how much could I contribute? Well, if you were eligible the year that it started, which was 2009, and you haven't used any of your room, so if you include the calendar year that we're in, which is 2017, you'd have room of $52,000. So if you think, husband and wife, between two people, that's $104,000. And then, contribution room continues to be added each year. Again, tax deductibility, RSPs, yes. Tax-free savings accounts, no. This is also important when you start to think about, for example, let's say you wanted your tax-free savings account to be part of your retirement plan. Well, one of the things that I always recommend is once, you wind up your career and you start to then tap into the money that you've worked hard to save over the years, we'll typically spend money from the tax-free savings account first and RSP second. Simply because, when it comes to tax consequences, we want to try to, where we can, either defer tax on something. If there's a deduction available, great. And also at the same time, we want to try to divide or split income between spouses. Not the case, can't split income out of an RSP per se, but tax-free because it's not taxable. Gives you some flexibility for sure. And then here's a few more points around tax-free savings. Again, one of the questions I get asked is, is there a maximum age? No, there isn't, which is pretty nice. Creditor protection, I hardly ever get asked about that. I think that was something that was a much more common question maybe 10 or 15 years ago, but not so much perhaps today. But nonetheless, there are some differences there. So there's a whole lot of information on tax-free. Again, the reason that we thought it would be relevant for today is again, it's one of those programs that people know about but maybe don't always fully understand. And having said that, certainly feel free to make sure that you ask questions of your advisor or your financial professional and help them, get them to help guide you through this, right? Make some good decisions around how you can take advantage of this program, what it can do for you and your family. So speaking of family, one of the things that I encounter every day with clients is people are living longer across Canada, no question about that. The odds are if you live to 65, the odds of you living to 80 or beyond here in Canada are really, really high, right? So a lot of people dealing with parents who are getting up there in age, their life is changing, of course, and they're relying more and more on their adult children for help, guidance, and support. I do have some elderly clients as well, and I certainly see how their adult children are becoming more and more involved in their life, right? Speaking personally, I'm in that position right now too. I mean, my oldest daughter, she's been out on her own for a couple of years now. Our youngest daughter's finishing up university at the U of A, and my in-laws are getting up there in age. So are my parents. My in-laws live close by, right in St. Albert, and yeah, they're getting to the point in the stage in life where they're starting to rely more and more on my wife and I for help and support. And so when you start to think about those things, I mean, time, effort, energy, that's one part of it, but helping them make good decisions and, who they're working with as well are things that certainly are worthy of discussions. And sometimes it's awkward to bring up discussions, especially if it's about money, right, and financial, because, in large part, not to kind of cast everybody with the same stereotype, so to speak, but what I see is, a lot of folks that are in their 60s, 70s, 80s don't really talk about their financial circumstances with their children, and they never have. And so now they're at a point where there's a need to do that. Again, you can see there's other things on this slide here. One of the things that I help many clients start to plan for is, what if I end up in a situation where I can't live in my home any longer, and I start looking at my options and private long-term care. Well, the reality is you could be looking at anywhere from $2,000 to $3,000 up to $6,000 or more per month for that type of care. So, again, pretty substantial in terms of somebody's financial situation. So, things to begin thinking and talking about and starting to look at options as to how to create cash flow to do that, right? And then there's obviously the other piece of that, which is the emotional decision about moving out of the home that you live in, right? So again, a lot of discussions, a lot of things to think about. One of the things that I always talk about with clients as well is, make sure that if you're in that situation, or your parents are starting to be in that situation where they're having some difficulty making decisions, okay, what do you have in place, right? What do they have in place? Power of attorneys, pretty standard, and yet at the same time, a lot of people just simply don't have them in place, okay? So again, sensitive conversation to have, but again, a pretty important one to have. And the last one on here, to me at least anyway, I really think this is key. Get to know, again, if you have elderly parents, get to know who their advisors are. Whether that's their lawyer, their accountant, their financial advisor, their financial planner. Get to know who these folks are. If you have the opportunity, meet alongside of your parents with their professionals when they are meeting with them, and ask some questions about the advice that they're providing, right? Not that you're there to challenge it, but I think, again, for your peace of mind and understanding, making sure that they're getting the right guidance going forward, I think that's very, very valuable. So, a lot's changed, right? So, if you think about the traditional mindset of retirement, work to 65, retire, and probably live another 5 to 10 years. Okay, well, from a lifestyle point of view, that means a lot of things, right? When you compare to what the new timeline is really in today's reality, right? I can only think of all the clients I work with, a very, very small number. I probably count on one hand the number of clients who've retired and have not sort of gone back to work in some fashion, right? Whether it's part-time, whether it's consulting, whether it's volunteering, right? Again, having said that, I've got some clients who are now traveling extensively, but yet when they're back, they want to be active, they want to be engaged, they want to be involved, right? I think there's certainly a social component to that. When you think about the financial component here, we're now talking about funding retirements that, are no longer 5 to 10 years long. They're now 25 plus years. When I start working with a new client, one of the things we talk about is obviously, what's your timeline to retire? And, then we start talking about how long you need your money to last. And that's typically, we plan out to age 90. And in some cases, we're planning beyond that because, they tell me stories about, my grandparents lived till they were 98. My parents are now, in their late 80s, et cetera, right? So, from a financial point of view, that's a very big shift. And if you think about the number of individuals across Canada who have a defined benefit pension plan, that number is shrinking, has been shrinking for quite a number of years. So more and more people are much more reliant on their own personal savings, and how are they going to get there? So the most common question I get asked when I first start working with somebody who's thinking about their plan for retirement and getting that set in motion is, am I going to be okay? How much am I going to need to save? How much are we going to need to save to fund the things we want to do in retirement? And then, their next worry and concern is, are we going to run out? How's this going to all play out, right? So, they certainly, I think about my role as a wealth advisor, that's certainly changed, right? Mindset and conversations for sure. So to kind of bring, I think, some of this together, I always want to talk a little bit about what's a financial roadmap or a financial plan. It's a number of things, okay? I think often what I hear first from people is they say, well, I do have a plan. I've got these investments. Okay, you're right. That's a good starting place. However, your investments and your investment plan and your investment portfolio, that's one component to your overall plan, right? That typically is sort of the means to the end. You know, how are we going to get there, in other words, right? Your plan really should have some pretty clear definitions. When I think about, you know, what is a sound financial plan, you know, I think about things like, you know, what kind of lifestyle do you see yourself leading? You know, again, if retirement is the goal here, for example, what are the things that are going to be important to you in retirement? What do you enjoy doing? What would you like to do more of, right? And then when I think again about some specifics is, you know, retirement certainly can be one of those goals. Sending children or grandchildren to university, you know, there's another financial goal. And they should have a pretty clear timeline on them. And then from there, should be able to put together a plan that says, all right, here's how much I'm going to need in dollars and cents to achieve those goals at whatever time frames you've established down the road. And you know, I think the reality here too is plans change. There's hardly any client that I can think of that when I get back together with them a year out from the time that we first created their plan, that nothing's changed. I mean, in almost every case, something has changed in their life or their circumstances, so we go back and say, okay, what do we need to revisit here? Have some timelines perhaps change, and what would we do about that, right? So lots of things to think about, but again, you know, a financial plan can be, you know, doesn't have to be really, really lengthy. Again, the piece that's most important is that there are some specific goals laid out, and there's a very clear plan as to how to get to those goals. So I'll just throw out an example here quickly. Of course, this isn't the client's real name. I use someone else's information here, but this is we'll call this lady Emily. When I met with her originally, and this is going back a couple of years now, you know, she talked about a few things, and these were the things that she talked about in terms of being most important to her and her family, right? So, you know, really from there, what we did is we said, all right, well, you know, there's a number of different wealth considerations that we could, you know, we could bring into your financial plan. Which ones would be most important based on what, you know, what she felt was key to her and her family. So, you know, we really began there and said, okay, well, you know, we need to build out a retirement plan. We need to make sure that there's a component there that addresses tax management, not just pre-retirement, but certainly into retirement. So again, the whole idea of making sure that, you know, you don't run out of money in retirement, and at the same time too, when we are streaming cash flow from your investments, that we're doing it in a way that's you know, that's smart from a tax point of view. You know, we also did some great work for this lady and her family around insurance needs analysis. So making sure that, you know, they had the right types of coverage in place for the stage of life they were at. You know, oftentimes I'll find that people, you know, they may have had the right coverage when they first, you know, set up the policy with their insurance provider, but their circumstances have changed, right? So, you know, maybe you don't have the right type of coverage in place anymore, and or maybe you don't have the right amount. And even in some cases, I've seen where, you know, clients have a coverage in place that actually doesn't make sense any longer. They're actually paying for something that they really don't need at this point. So lots of things to think about. So, you know, regardless of who you decide to work with as a financial planner or wealth advisor for that matter, I really believe these are 5 key questions that you should ask You should feel comfortable asking these questions. The person that you're potentially going to work with should feel comfortable answering these questions and giving you as much detail and information as you're asking for. And this, to me, really is about, trusting your instincts here, right? And at the end of the day, you need to be able to trust the person and the firm that they're with. I think it's great if you like them as well, but the most important part here is that there's a level of trust built there. I really think these are questions that'll help you get to that place. I have things that I do in my practice very consistently. One of them is about question number 4. I'm very clear with clients about how I get paid, because that shouldn't be a big secret. Okay, that makes some of the folks in my industry uncomfortable talking about. In fact, some of them are uncomfortable talking about the cost of investing. Well, in my opinion, I think that needs to be very transparent. You need to be able to determine value, and that's, in my opinion, 2 ways to figure it out. There is a 6th question, which isn't listed here. However, I think it's a really relevant question. I really would encourage you, ask your potential financial planner or advisor about their professional credentials and what do they commit to in terms of ongoing education. Because I think you really want to be working with somebody who's committed to continuing to improve their knowledge and their skill base. I'll call it the advertisement for TV, but I think it's probably at the same time a really good snapshot of what a certified financial planner can do for you, whether they're at TD or not. I think myself and my colleagues at TD across the country, and there's about 900 of us coast to coast, we typically work with people who are 5-10 years away from retirement. In some cases, people that are now transitioning into retirement. But if I look at my client base, about 75% of the clients that I work with are approaching retirement, so pre-retirement stage, if you will. In terms of assets, I work with clients, typically with somewhere in the range of $250,000 in investments up to the $1 million mark. At that point, I'll typically introduce one of our high net worth partners at that point. So, that's a quick snapshot. Every client that I work with, and it's the same for my TD colleagues across the country within financial planning, they'll receive a personalized financial plan right out of the gate once we've established those goals and how we're going to get there, and then we review that progress every year. So, it's not a case where, we deliver a plan to a client and then, sort of send you off your own devices and never revisit again. That's crucial to making sure that we're on track and again, that we understand what's important to you and your family, what's changed. So at this point, I think the only slide left is the disclaimer, which won't take time to step through that one, but I really want to take an opportunity to say thank you. It was tremendous to get the invitation to do this today, and have certainly had an opportunity to have some conversations with the folks at Athabasca University over the years through various events and so on. I've been lucky enough because I live in the Edmonton area, so I get an opportunity to do that. So I think at this point, Fareed, we're going to open it up, correct? For any questions that people might have, right?
Yeah, that's correct, Scott. Thank you so much for the presentation. So, so this is a time for the questions and dialogue. So if you have any questions, this is a good time to start asking them. And again, just to let you know that just typing your questions in the question box you see on the screen. And Scott will be more than happy to answer any questions you may have. And also just to let you know that you're able to download this presentation right now. If you go to handout section on the screen, and if you click on the PDF file, then you should be able to download this presentation as well. Also, another note is that this webinar is being recorded. So if you want to refer it back in the future, we will send you the link to this presentation as soon as the file is ready. So with that, I'm opening the time. We have about 25 minutes for questions and answers. So if you have any question and answer, start typing them in. Thank you. So Scott, in your career, how has it? What have you seen that in the past? I don't know, trends from 2008 financial crisis to now, in terms of what's happening with planning, and what other tips and advice could you give to our listeners today? And you know how volatile the market is, right?
Yeah, so good question. You mentioned specifically 2008. So, when I think back to what happened in 2008, whether you want to call it the perfect storm or you've got, some other way to think about it. I mean, it was one of the deepest, financial market setbacks that, I think we've seen in our lifetime. You got to go back, pretty much a century to see something that significant and that deep in terms of a negative, outcome. And so, lots been written, lots been talked about, obviously, as to why it happened, how to prevent it from happening again, and that's all well and good. What I think about most, though, and what I talk with clients most about, is how do we set you up so that you're in a position where you can weather that kind of a storm. Mm-hmm. So one of the phrases I use is, is your financial plan and your investment portfolio retirement ready? Okay. So if you think about somebody who retired in 2008, okay, well, a few things are at play here, right? You're retiring, so your income has now been reduced significantly, okay? You're now starting to spend your savings, okay? And you've also experienced, in all likelihood, unless you're invested in cash or GACs, you've experienced a very significant decrease in the value of those investments that you're now streaming money out of. Well, that could be catastrophic, okay? So I'd say one of the big things that has changed since 2008 and, lessons learned, when we start to think about constructing somebody's financial plan, we tend to set things in motion so that, we really make sure we've got a clear idea of what all of the financial goals that the client has, right? And, their sort of family unit, so to speak, right? Retirement's one of them for sure, but we think about retirement specifically, it's very rare to see anybody, say, well, look, I'm going to spend my entire savings that I had earmarked for retirement in the first year or two that I'm retired, right? So, we know because we're living longer, we need to stream that over a longer period of time. So what tends to happen as a result now is when we build out the investment portfolio, we'll tend to build things so that we're not, invested. If you think RRSP, for example, we'll have multiple investments within that client's RRSP, okay? So we'll have a pool set up so that, okay, here's your short-term money, and we make sure that that's got limited downside volatility potential. And then we've got another pool of money that's probably going to be our income stream for, maybe 3 to 5 years into retirement, last us 5 years. And then we've got another pool that's set up for, even further down the road. And we've got those invested quite differently. And right. In part, again, is to try to, as best we can, take away as much of that downside potential as possible. There's no way to ultimately eliminate it, again, unless you're going to sort of sit on the sideline. And, given inflation and current interest rates, my advice is if you're going to do that, you'd be better off to spend the money you have today then. Because in terms of buying power, if you want to go buy a $50,000 vehicle, well, a year from now, given inflation, that vehicle is going to be more, right? So, yeah.
Okay. Great. Okay, so we have a couple of questions in already. So the first question is from James. His question is: are there any other saving strategies we should consider to prepare for retirement? What percentage of income should we be allocating to savings strategies? Great question, James.
Okay. So if I'm understanding the question correctly, I think what James is asking is, along the lines of, saving for retirement, and as you're approaching retirement, should you start to shift your investment strategy more to an income focus versus a growth focus? Is, again, I might be misinterpreting, but
yeah, I think what he says is, well, the second question is, what percentage of income should we be allocating to savings? I guess, is it 50% of your net income, 25%?
Okay, gotcha. Okay.
Yeah.
That's an awesome question. So, I mean, the way you're going to determine the answer to that question, there's no one right answer, right? You read some books and they'll say, well, say 10% of everything you make, 10% of your gross income. Some things they say 7%, 15%. There's no one right answer. I guess the way I answer that one is, I think you got to work backwards. So you have to start with saying, okay, well, what does my lifestyle look like right now? How much money do we actually spend every month in our household? What's that actually going to look like when we do retire? We'll make the assumption that, mortgage is paid off. Hopefully the kids are through university and you're not paying for them anymore, but they might move back, who knows? Right? Now, on the other side, you might have, on the other side, you might have things like travel, right? You might say, well, hey, we want a dedicated travel fund for, X number of dollars every year. Now, once you've established that, what you have to do is then think about that in future dollars. Say, okay, well, let's say to do that, it's going to cost $70,000 a year to do that in today's dollars. Well, then we've got to factor in inflation, right? Say, okay, well, what's $70,000 going to be 20 years from now, for example? So once you've established that, then again, it's back to the beginning to say, okay, if we've got some money saved right now, what's our future rate of growth, reasonable expectations of growth, and then from there, how much more do we have to save? So I think to me, that's kind of the way to answer that question. If somebody was going to say, well, just that sounds great, Scott, but just give me a percentage, I'd say, okay, you know what? Start saving at a percentage of income that makes you notice it. Okay, and what I mean by that is you start to have to make some trade-offs. Okay, so instead of maybe going out for dinner every Friday night and spending $150, you pause and think about that because you think, well, wait a second, maybe I'm not as flush in my bank account as I was before since I started the savings plan. So if you want to pick a number, pick 10% of gross income, great, start there. I think the bigger point is just the fact that you've started. And the more time that you've got ahead of you, I mean, the better, obviously, right? When I see clients, and I don't see it often, every once in a while I'll see a new client introduced to me that's in their, say their 30s, right? And the fact that they've started saving and accumulating, I just look at them and say, okay, you guys, you're ahead of 95% of your peers already. You've got time on your side here. So, I don't know if that was a great answer, but
yeah, I think it's,
I think it,
yeah, go ahead.
Yeah, I think it depends, right? Because it's all driven by personal circumstances, right?
Yeah. Okay, great. So James was happy with the answer. Thank you, James, for the good question.
Thank you, James.
Yeah, here's a second question from Shauna. Hi, Scott. Our investment advisor set up a meeting with us and told us we had to change some of our investments to be in line with our investment preferences. Investment preference questionnaire. Could you explain those requirements? So, yeah.
Okay. So you know what? I'd say good news. If your advisor is revisiting your investment preferences and your investment profile, ideally, I mean, maybe I'll back that up. Maybe I won't use that word. In my practice, that's once a year, for sure. And in some cases, depending on what's going on in somebody's life, we might revisit that a couple of times a year, okay? But most often we revisit that once a year. So on the one hand, hopefully you don't feel like it's an exercise from, a regulatory or compliance point of view. I mean, it certainly is, okay? There is a requirement that if you are a licensed advisor, that, you do revisit your client's investment profile and their investment objectives on a regular basis. There's no sort of standard, okay, it should be within this time frame, okay? I do it once a year. My colleagues across the country do it once a year. Every firm's a little bit different. But I think the good news is they're revisiting it with you. And the important part of this is to make sure that there's clear understanding as to, what's changed, right? Maybe your mindset has changed. Maybe your tolerance for volatility of your investment has started to change. Maybe your time horizon has changed. So by stepping through those questions, that's one way, and it's certainly a key, fundamental, foundational way for your advisor to be able to then determine, okay, do we need to make a change here, right? And so I'd say, that's good news. They're doing their job there for sure. At the same time, too, again, hopefully it doesn't feel like it's just a checking a box and it's a regulatory process. Well, we've got to do this, right? I mean, to me, it's really about taking time to understand what you're thinking, what you're feeling, what's important to you, and what's changed, right? I think the worst question, I don't want to throw anybody in front of the bus, but I think the worst question an advisor can ask is, well, so has anything changed? Well, that's a closed-ended question, okay? And it doesn't have much context to it, right? I think a much more open-ended question and asking about things that, you as a client would have talked about last time you met, that's a way to start to get some insight. So, yeah, I think it's a great question. I'm glad to hear your advisors actually is doing that. I think that's key.
Good, great, thank you. Next question from Olivier. Olivier's asked, how frequently do advisors typically meet with their clients to review or reassess their financial plan? So this is about frequency of meeting with advisors.
Okay, yeah, awesome question. So, again, I think every advisor's practice can be a little bit different. And I think it's primarily driven by the client's needs, right? So, I have a minimum standard that face-to-face, I'm going to meet with each one of the clients that I work with once a year. That's the absolute minimum. Every once in a while, I'll actually have a new client that says, oh, no, don't worry, we don't have to get together. If I need something, I'll call you. To me, that's a bit of a red flag. And it's a red flag because, if there's not a commitment on the part of the client to actually work with me in that respect, if it's just about the investment, I really can't do my job the way it should be done for the client. So, minimum is one specific. I typically talk with my clients, I'll make sure I pick up the phone and follow up on something that they might have mentioned, when we met 2-3 months ago, but I'll typically have some conversation with them, between meetings over the phone, an additional 2 to 3 times over the course of the year. And sometimes, there may be cases where, a client's going through a pretty significant change. So I'll use this example. Had a lady who told me about, it's probably about June, July of last year. She says, Scott, we've been working together for a while. I think things are, going great in terms of my retirement plan and so on. She says, I've made the decision. I'm going to retire in May of next year, so May 2017. I said, okay, great. I said, I feel like your plan is on track. At the same time, too, I think it'd be really important for us to have, an opportunity to check in here and actually get together, maybe about 3, 4, 5 months before you retire here. And that's exactly what we did. So, again, in that case, I met with her, I think, probably face-to-face 3 times over the course of the last 12 months. So good news is she's retired. Retired at the age first. And, they're actually living the dream. They've gone on I think first trip they went on was a 45-day cruise around the world, and they're planning another one here for September. It's going to be pretty expensive. So, again, I think that question is a great question. How frequently should your advisor be meeting with you? In my view, the minimum is once a year, and I think at the same time, the frequency should be driven by your needs as a client.
Yeah, and also I think, Scott, you brought a great point, that clients have to remember that they are paying financial advisors for the service. So good service meaning always having constant communication and providing updates. Providing information that the client may or may not always aware of, right? So I think that is key in terms of any types of services that clients look for or use to have really good customer service component for that.
Exactly, and if I could just maybe add one thing that comes to mind as we're talking about this, there was one of the slides that we had up earlier that said, here's 5 questions to ask, a financial planner that you might decide to work with, and I added on a 6th one. I think I would actually add on a 7th one. And I've been asked this a few times, and over the last probably couple of years now, I've actually started to talk about it without being asked. Clients will say, well, how many other clients do you work with? I think that's a very good question, because if the answer you get back is, well, I work with 400, 500, 600 relationships, how much time is that planner, that advisor really going to be able to commit to you? Like, there's only so many hours in a day, right?
Yeah.
So, without getting too far into the weeds here, I mean, I've got a pretty specific sort of top end, if you will, in terms of the number of clients that I am willing to work with. And that's simply because, if I'm going to deliver what I believe is important to the clients I work with, I have to be able to commit, the time, effort, and energy. And, it's got to be realistic, right? So, yeah, if I was going to add a question, I'd say that would be a good one to ask.
Great. So we have time for just one more other question. So if you have any questions for Scott at the moment, this is a good time to ask a question. Okay, here's a question from a follow-up question from Olivier. Are consulting fees always taken from a percentage of the investments your client has with you? Oh, this is a great question about fees.
Okay, sorry, I didn't get the first part of that question.
Yeah, I can repeat that, no problem. Are consulting fees always taken from a percentage of the investments your client has with you? So do they get paid by a percentage of the investment that the client works with a financial planner?
Excellent question. Okay, so at this point in time, the way our firm is structured, the answer to that would be yes. Okay, so I'm sorry, Fareed, can you still hear me? It sounds like the line just went. Oh,
yeah.
There, okay.
Okay.
Sorry, I'll start that again. So at this point, how it works with the firm I'm at TD is the underlying investments that we then manage for the client, depending on what the investment choices are. So, in the traditional mutual funds, there's a trailer component to it, if you will. It's part of the overall management expense cost to the client. So a percentage of that comes back to the firm, in this case would be TD, and then a percentage of that comes back to your advisor, your financial planner, right? There are also other choices. So, for example, instead of traditional mutual funds, with many clients, over the course of the past 5 years, we've started to go a different direction, essentially a step past mutual funds, which takes us into more of a discretionary type of an account. That has 2 components to it. There's an administration fee, which is in dollars and cents, and the client actually sees that on their statement every single month, okay? And then there's also components of the management expense portion, which is similar to a traditional mutual fund. Not as easy to readily identify in dollars and cents, but still we explain that. So again, same idea, percentage of that comes back to the firm, percentage of that comes back to the advisor. Where you're going to see the industry really go, and we've already seen this start to play out, is what we'd refer to as fee-based investment accounts. So in other words, there'd be a very specific dollar amount that the client would pay as a fee over the course of the year that would be upfront identified. And again, a portion of that would go back to the firm and the advisor. And what we're, certainly what we're going to see is going forward we're going to continue to see cost to the investor reduce. We've certainly seen it come down in the last couple of years. We're going to see that going forward. There's absolutely no question, which is great for investors. I think that, you know, anytime you can reduce cost of investing, that's a dollar that goes back into the client's pocket, right? In terms of maybe also addressing another part of that question, you know, I do get asked sometimes, well, look, Scott, you know, if I want the financial plan, however, you know, let's say I don't want to sort of pay for it, if you will, in the sense that, you know, we'll have TD or, you know, me on behalf of TD manage the investments. You know, can I pay a fee like I would to a lawyer or an accountant for, you know, billable hours? There are a very, very small number of financial planning firms. There are small boutique firms across the country that do that type of work. Hasn't really taken off the way that I would have thought it would have. Again, they're sort of few and far between. They'll charge anywhere from sort of a low end of about $1,000 to $1,500 to construct a, you know, comprehensive financial plan, all the way up to, you know, $5,000 plus, depending on the complexity of the person's situation. So, you know, again, in terms of establishing value, you know, again, that's one of those things that you want to try to understand. I think, you know, the other thing I would mention here is, as we continue to go forward here, you know, absolutely we're going to continue to see cost of investing reduced. I think the challenge is going to be for what I would sort of refer to as maybe, I hate to use the word smaller investors, but, you know, in terms of dollar value, I think it's going to become more challenging for clients with sort of under that $200,000 to $250,000 level in investments to find an advisor that's, you know, open to sort of taking them on as a client. Because if you think about reducing cost of investing, that's going to mean, you know, reduced stream of income to, you know, an advisor. I mean, we're no different than any other professional. Costs to cover, right? Bills to be paid. You know, you're going to, I think, see more financial planners and advisors start to maybe shrink a little bit in terms of the number of clients they work with. However, the sort of the average dollar value of the client they work with will move up incrementally. I hope I answered that question. I really did.
Okay, great, Scott. Thank you so much. Okay, and Olivia says thanks. So you did answer this question correctly, or, you know, with more information to think about. So with that, I think we only have a couple of minutes left. I'd like to thank Scott Dunn, our MBA of 2004. Thank you so much, Scott, for your time and for your insights today and talking to us about financial planning and what to look for. So really appreciate it. And thank you to all the listeners who tune in today to our webinar learning series. And look out for more future webinar series coming up. So with that, I will say goodbye and thank you again for tuning in. And if you wish to listen to this recording again, we will send you the link to our YouTube channel once the presentation or the video is processed and ready for upload. So again, thanks so much, Scott, for your time. And everybody, have a wonderful day.
My pleasure. Thanks so much.
Thank you. Thanks. Bye-bye.